How's everyone doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about why are banks selling their insurance units. I have mentioned this in episodes past. I think I've definitely talked about this in a couple of the weekly banking updates that I've done over the last 6 months. I think I've also mentioned it in passing in some of the other episodes that I've done. But I saw this an absolutely fantastic article on Bank Director talking about this whole thing, and I want to bring this in. So this article is called "Is It Time to Eat the Golden Goose and Sell Your Insurance Business?" And this is written by Lucas Parris. And basically the lower title is "Banks are selling more insurance businesses than they're buying." So let's get into a little bit. So why is this? So it basically starts out by saying a decade ago, interest rates were near zero. The S&P 500 was close to 1,600, and Bitcoin finished the year at a mere $300. The narrative at that time was that the lingering effects of the Great Recession, higher capital requirements for banks, and frothy valuations for insurance agencies driven by private equity bidders had firmly crowded banks out of the market for buying insurance businesses. Over the last 10 years, a few banks invested in their insurance agency operations, though mostly for organic growth. At the same time, market multiples and private equity's appetite for agencies only increased, leading to some very favorable outcomes for banks willing to sell those businesses. Sellers in recent months have included Truist Financial in Charlotte, Trumark Corp in Jackson, Mississippi, and BOK Finance Corp in Tulsa, Oklahoma. So, how do we get to this point? What is the next step in this cycle? The differential between PE multiples for banks and insurance brokers has been widening for several years, due in part to market dynamics and interest rates. This has led to lower returns and expectations for banks compared to public insurance brokers. And then we have a great chart here that basically says PE multiple differential between banks and insurance brokers. So you can see here insurance brokers are looking at a 20.9 times multiple on their PE, price to earnings, whereas S&P US BMI Bank Index price is basically at 13 times. So it would make sense for banks with significant insurance operations to wonder if the value realization of $1 of insurance income would be better captured outside the bank's typical pricing multiples. So this arbitrage of earnings multiples has undoubtedly influenced many sellers of bank-owned agencies. As observed by S&P Global Market Intelligence, 2023 was the first time in at least 8 years that U.S. banks sold more insurance agencies than they acquired. So you can see here another really good chart. This is from S&P Global Market Intelligence. It basically says bank divestitures and acquisitions of insurance agencies. So we go here, it goes 2017, 2018, 19, 20, 21, 22, 23. And so we can see here that in 2017, divestitures were 10, whereas acquisitions were 28. In 2018, similar pattern, 10 or 12 divestitures, 24 acquisitions. In 2019, 3 divestitures, 19 acquisitions. 2020, 10 divestitures, 18 acquisitions. You're kind of getting the pattern here. 2021, 7 divestitures, 23 acquisitions. 2022, 6 divestitures, 21 acquisitions. But then this year, 10 divestitures with only 6 acquisitions. So the strategic rationale for the latest group of divestitures has been largely consistent. Capitalizing on the sale of an insurance unit at a favorable valuation provides several potential benefits, including, number one, allowing for capital redeployment from lower yielding to higher yielding securities. Number two, offsetting losses from a securities portfolio repositioning. Number three, enhancing capital ratios. Number four, creating tangible book value per share accretion. And then number five, providing more support and focus for the core banking business. In certain circumstances, the driving force behind a transaction might be the strategic imperative of a particular acquirer, such as the desire to bolster presence in a geographic market or to double down on a particular line of business. It is worth noting that the price paid as a multiple of insurance revenue is only loosely correlated with size. Margins and strategic considerations factors more prominently into earnings and EBITDA multiples. And then the final, I believe this is the final chart. Yeah, final chart here. So this is earnings and EBITDA multiples for select agency transactions. So we have kind of the deal value in millions, and then we have the divested agency and then the bank partner. So we could see here in April 23, you have the D value EBITDA versus the D value in earnings, and we can see here that in April of 23, the D value slash earnings were higher than the D value EBITDA. Same thing for November of 2023, and same thing for December of 23, February 24, April 24th. So right now, like you said, you have this, the D value on earnings is a higher multiple than the D value on EBITDA. But here we can see here the deal, 36 million, and it was South Plains sold Windmark. Evans Bancorp sold Evans Agency for 40 million. CB Financial sold Exchange Underwriters for 31 million. Truist Financial sold Truist Insurance for maybe that's 15.5 billion. And then Trustmark sold FBB Insurance for 316 million. Are bank acquisitions of insurance agencies a thing of the past? It says not necessarily. Hindsight's always 2020. Perhaps banks should have pushed back against the private equity buyers over the past decade and been willing to bid higher on deals. In retrospect, paying up to 12 times EBITDA for a small insurance agency doesn't seem that crazy when the consolidated unit can now be monetized at 15 times. Often, the best determinant of total return in an acquisition is the entry price. So if a bank has the ability to source proprietary off-market agencies or books of business through local connections, that strategy is still well worth considering. But what about banks that already have an insurance unit? Like, what steps should they take? And so here's a few suggestions. Conduct a strategic evaluation of the agency in the context of the overall strategy. Does the agency fit into long-term vision? Is the sum of the parts greater than the whole? What is the agency's true earning power or valuation on its own? Consider obtaining an independent valuation or quality of earnings study to analyze the financials. Ask the difficult questions and examine the business in the way that a potential acquirer would. Is the business ready for sale? Is the corporate structure clean or messy? Do you have a collection of third-party producer arrangements that must be consolidated? Are there minority owners? How does the expense allocation and or resource sharing between the bank and the agency work? Do you have alignment between the agency and bank management? Are there separate boards? Intertwined management and or ownership? Would a sale create potential issues of conflict or necessitate a fairness opinion? So, and then the article concludes by saying the overarching question to answer is whether selling a business that took 20 years to build is the right long-term move. Maybe. Is it short-sighted to sell off a golden goose agency in the name of balance sheet repositioning? Maybe not. Each situation and transaction is unique. Clearly, the banking and insurance industries are at an interesting place right now. And if you are a participant in both, then you have a few options to consider. So fantastic article. I mean, I love how this article, it talks about here, some great charts in here, just showing the earnings and EBITDA multiples for select agency transactions, showing the pattern of bank divestitures and acquisitions of insurance agencies. And then we talk about the PE multiple differential between banks and insurance brokers. So it's a very interesting thing to point out right now. So basically right now, the multiples are high for insurance brokers, for private equity firms, whatever. They're basically paying up for these books of business. So it makes a lot of sense for banks right now. Banks can basically sell these things and make a lot of money. But I think a lot of the questions that it asks at the end, it's basically like, again, I think it depends on the situation your bank is in, right? Like if you've got a situation where you need to prop up your capital ratios, you need to offset the losses from a securities portfolio, or you want to redeploy that capital from low yielding to or higher yielding securities. If you want to create tangible book value, if you want to provide more, support and focus just for the core banking business, like those are all great reasons why you would sell right now, to basically take that money and reposition into it other places. But then as you get down here, again, um, conduct a strategic evaluation of the agency in the context of the overall strategy. Like, does it fit into your long-term vision? Does it not? What's their true earning power or valuation on its own? Get an independent study. Is the business ready for the sale? What's the corporate structure like? Is it clean? Is it messy? Do you have alignment between the agency and the bank management? So these are all fantastic questions to ask and consider in your analysis of whether or not you would or would not sell an insurance business. I think, and I would say here, I think there needs to be some kind of um, I think there needs to be some kind of underlying issue there for a bank to want to get rid of the insurance business right now. I mean, other than just they could get a good price tag for it right now. They could get a higher multiple for that business unit at the moment. Like, I think there needs to be something there. Like, if you've got underwater securities portfolio and you got to reposition that, and you're going to take a big hit, and you need to offset that loss on the securities with maybe the sale of a business unit to make that work, then that's a strategy. Maybe maybe you're low on capital. You got to replenish your capital to stay within your capital ratios. Maybe, like you said, maybe you have some kind of messy ownership structure, and just being in the insurance business just doesn't really make sense. And it makes more sense to just kind of get rid of that and deploy that cash back into the core banking business. There could be a lot of reasons for that, or for why you would want to do that. But I think there's also a lot of great questions there just to ask. And I think even if everything is fine in your insurance business, I think there's a lot of great questions here to ask. How does this business fit in with the long-term vision of the bank? Like, do these things complement each other? Do they work well together? Are they not? Like, how is the insurance unit performing? Do we see long-term growth in that unit over time? Could we use that? Could we get a nice chunk of change for it and deploy that money elsewhere in a more strategic way that really benefits the bank long term? I mean, so again, just a lot of great questions. There are a lot of things to think about. I think it really helps if you've been sitting out there wondering, like, well, why are banks selling these insurance units right now? Now you have a very good answer as to why that is happening and why that's taking place. So I think so. Again, I think this was a fantastic article. Lucas did a great job in writing this. Really hit a home run on this one. I really enjoyed this one, and like I said, provided a lot of great detail, a lot of great information for everybody to think about. So I will continue to keep an eye on this trend. I think the next 6 months into next year will be very interesting to see if this, reverses course, or if we continue to kind of accelerate with banks, getting rid of their insurance units, because now is just a good time to sell those. We'll see. Like I said, we'll see how that plays out. But I'll keep everybody updated on whatever happens in this arena as we continue to move forward. But anyway, so if you like this video, please make sure to like, share, and subscribe, as that helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below, as I always like to get back to everybody. Check out some of the other episodes that I've posted up this week, including the weekly banking update. I posted a video on Fed Now. I also posted another video where I talked about the SCOTUS decision on the Chevron deference and what that means for banks. And then this weekend, I will have another round of new videos along with the weekly update on Sunday. So please stay tuned for that. And hopefully everyone has a great week, and I will see everyone again real soon. Thanks a lot.